Hello, everyone, and welcome to another episode of the What the Finance podcast, where we talk to experts to learn about all things finance, investing, and trading. And on today's episode, I'm happy to welcome Robert Ross, professional stock analyst, founder of Tick Stocks, and author of the upcoming book, A Beginner's Guide to High Risk and High Reward Investing, from cryptocurrencies and short selling to SPACs and NFTs, an essential guide to the next big investment, which is releasing on May 10th this year. So, Robert, thanks for joining the podcast. And I guess, can you talk a bit more about your sort of own experience in investing and how you've gotten to this point?
Sure, and thank you so much for having me on the show. It's great to talk to you today. My journey in investing kind of started like a lot of people back in college. Took a bunch of econ classes and entrepreneurship classes at the same time. And after I graduated into what a lot of millennials I think can relate to, right into the great job market post-global financial crisis, where there wasn't really a lot of jobs, especially for young people, which makes sense in hindsight, though, because there were all these, Gen X and boomers who had just been let go. So it'd be going to like apply for jobs, and for entry-level positions, they wanted like 5 years experience, which just made no sense. But when you think about it, the labor market was all screwed up at the time. But I was able to secure an internship at Merrill Lynch in their wealth management division. And at the same time was working at a think tank writing about economic policy. And, I liked, all the people I worked with at Merrill Lynch. Shout out to Lubin Meyer. Thank you for giving me my start. But financial advising is just more of like a sales job. And I really enjoyed more of the research aspect of it and the writing aspect of what I was doing at the think tank. So a professor, we had published papers together in college. We had a very good relationship. Walter Block. We don't agree on everything. If you Google him, he's a little bit out there, but he helped me a lot in my career and set me up with a company called Casey Research, which basically combined the financial research I was doing at Merrill Lynch with the writing that I was doing at the Pelican Institute for Public Policy. And, kind of started out there helping, do general stock research for a few of the editors at Casey Research. Kind of picked it up pretty quickly, because not only I had a lot of writing experience, but I was just really interested in businesses and investing and the best way to help our readers make money out of what was happening in the economy at the time. And when they wanted to start a sister company called Malden Economics with financial writer John Malden, they tapped me to be the senior equity analyst at the time. I was 25, had about 3 years experience under my belt. It was a little over my head, but I was thankful. I got to work with really smart people right off the bat, though. I'm sure everyone out there has heard of Real Vision. First guy I worked for at Malden Economics was Grant Williams. He's got a huge Twitter following, really great guy as well. And I also got to work under Jared Dillian for about 4 years. I was his analyst. Another great follow on Twitter, and a great writer as well. Learned a lot from Jared, both about investing and writing as well. And eventually they had me, write my own products where I got to be the face of and really just teach retail investors of mostly an older audience what was happening in the markets and how they can make money off of it. But, there was a point, though, where it was like, I'm, in my late 20s. I love my job, but all my subscribers are like in their late 60s, early 70s. So like eventually this audience isn't going to be there anymore. And I'm going to be, my late 40s. And I'm like, okay, like, what am I doing here right now? So I knew I always wanted to, and I had seen statistics basically saying that, millennials are one of the most underinvested generations in history, probably because they have such a big debt overhang, from student loans and everything, at least here in the States. That they really, most millennials and Gen Z, a lot of them learned through YouTube, which I just, I was never a YouTube guy. I was always more of a traditional analyst. I probably because I had access to all, these research reports and all these really smart guys and gals from working at Malden Economics. So eventually, I basically turned one of my articles that I had written for MarketWatch into a TikTok video. Didn't really know how TikTok worked at the time. I probably used the platform for like 3 or 4 days and kind of based my persona on this guy, Flaky Salt, who's like a food blogger, food YouTuber. He's kind of like an eccentric food chef. and uploaded the video. It got like 15,000 views. I was like, oh, so I should probably keep doing these. There was nobody was really doing finance content on there at the time. There were some personal finance people, but no one was really doing like stock research, which was my specialty. It's what I'd done my entire career. So I just kind of kept uploading videos, at least once a week. This was in November 2019. And then, the lockdowns happened, the pandemic happened, and then retail interest in the stock market just went crazy. So I was able, over that following year, amassed about 350,000 followers on TikTok, and eventually expanded to Instagram, where I have, another 35,000 on there now. That was when Simon & Schuster reached out about writing a book for beginner investors, because all these investors, these new retail investors, wanted to use these high risk strategies, but they didn't know anything about risk management or really how to use them responsibly. So that's what the whole book is about. Basically, if you want to do something risky, this is how you do it in a smart and calculated way, where you're not going to blow up your brokerage account. The book is out. Got a new show on YouTube with Genevieve Rock-Decter, another great Twitter follow, former portfolio manager, called The Bullpen. So everyone should go watch that. It's a great show. And now I'm here talking to you on the podcast.
Awesome, and a great journey. And I guess that's really interesting because, as you said, like, it's scary to think that most people learned how to invest on YouTube, because I've watched a lot of YouTube videos and I've made a lot of mistakes, maybe from listening too much to them. So that's the thing. I think when I read your book, it's like, wow, this is actually good content compared to maybe some stuff I've listened to previously.
Yeah, and that's when we were I first started doing the TikTok stuff, because we were going to do a YouTube channel for Malden Economics, and they were kind of dragging their feet on the project. But the whole time I was like, the content on here sucks. It's terrible advice. It's all like, oh, like I timed the market so well. There's one because I'm such a genius. It's like, well, maybe that works like, a handful of times, but for what? And people can do that. There's a small percentage of the people who, are like, master traders or whatever, but that's not what retail should be trying to do, So I think there was a huge opportunity for that there. And I think there still is. I still think the quality on YouTube is not that great. There's definitely a handful of great creators on there. But really across social media, they just don't have a lot of experience. So that's one reason I've teamed up, with Genevieve Rock-Decter. She was a former portfolio manager, beat her index for, I think it was 5 years in a row. It was like a multi-million-dollar fund. Now she left to do, teach retail. So we've teamed up to kind of, help retail out and really dispel a lot of the, the myths and the mistakes that a lot of retail investors make. Because I've definitely made mistakes. And, you read the book. I think a lot of people, they're like, because I have a case study on each chapter. It's not all wins. It's like a lot of like times that like I personally biffed a trade or biffed a strategy, or someone I know. I brought in a lot of people on it who, there were certain chapters I'm just not an expert on. I didn't feel comfortable, writing a case study on or a how-to guide. So I would bring people outside help and even some of their stories. It was the same thing. So I think, talking about your losers is equally as important, if not more important, than talking about your wins. And I tried to have that come through in the book.
Yeah, it's really important, because you could say that, I guess, the market landscape of the past few years has been quite beneficial for almost every trader. Like if you're long on the market, you've hopefully made money, unless you made some big mistakes. I guess that's the risk as well. Like a lot of these people haven't maybe experienced that bear market that we've seen maybe the past few months.
Exactly. And I think a lot of people, I always say the worst thing that can happen to someone when they first start investing is that they make a bunch of money right away, because then they're like, oh, this is so easy. This time is different, all these SPACs, think about the future of these companies. You see what Kathy Wood said? Oh my, and it's just like, okay, this is clearly like a speculative bubble, and you can make money in bubbles. But it's really hard to know when to get out, and I think a lot of people, they made all that money right away, and then it came back down. And they're like, oh, you got to buy the dip on this one. You got to buy the dip on ARK. You got to buy the dip on these high growth stocks. And now, they have just fallen for a year straight, because these young investors, they don't understand how long duration assets work. They didn't understand how inflation would affect these companies that aren't making any money right now. So that's what I try and do, both, in my my social media channels, my book. I have a Patreon that I try and, educate people, which is basically the same product I used to run at my old company. It's just a tenth of the price. And way more memes than in the new one. But yeah, I try and, just help, because it's a very confusing market. It's confusing for me. It's confusing for, people who have decades of experience. So what I try and do, and I also, one thing that both Jen and I do on the show, we don't pretend to know everything either. Because, once you start doing that, the market will probably soon humble you afterwards, as always happens. And anytime you get cocky in the market. So we try and keep it, on the level on the show.
Yeah, I think that's important to, for people to learn. It's just, you're never going to be right all the time. And the goal is, and I think a key point throughout the book is sort of risk management, especially with these high risk investments, that you have to have the risk manager to make sure that, say, if you have a loser, it doesn't wipe you out completely, which I think, as you mentioned, some people who maybe win all the time, they might just be risking more and more.
Exactly. And I really put a strong emphasis on cutting your losers fast in the book. I think I read it originally in One Up on Wall Street. It's like my favorite investing book ever, Peter Lynch's book. It talks about how, and I don't think a lot of retail investors, is basic math, but I've made a video on this before and I saw the light bulb go off with a lot of people. But it's like, if a stock falls 50%, it has to rise 100% to get back to break even. So you want to, the goal, and I talk about this on my Patreon all the time. I'm going to miss on stuff. I don't think I'm some savant investor by any. I think I'm above average. But I don't think I'm going to be wrong on trades all the time, even if the thesis totally makes sense. One right now that has just not worked. Theoretically, it should have been one of the best trades of last year, but banks typically benefit when interest rates rise. So I thought, because their net interest margin expands, but that I hold VFH as was a way to express this trade. I actually bought some of it in March 2020, when everything was getting obliterated, because I was like, okay, banks are going to come back eventually. But, as interest rates have been rising, they haven't gone anywhere. I think that it's flat over the last year. So even if you have all the theoretical framework in place, everything makes sense, it still is not going to work out every time. And when that happens, you have to know either, for big banks, I'm happy to hold. It's a long-term hold for me. But, it's not always going to unfold the way you want or the way you expect. And really, I forget who said it, but it's even the best investors in the world are only right, 55% of the time, 60% of the time. It's all about managing the downside, which, we kind of roast Bill Ackman a little bit on our show. But, kudos to him for cutting Netflix the other day, too. He made a big splashy trade after their last earnings miss. But he had to come out. He's like, hey, I was wrong. And it's just even billionaire hedge fund managers get stuff wrong publicly all the time. So it's as a retail investor, it's do you think you're not going to get stuff wrong? It's it happens to everybody. So you need to figure out how to manage that risk and really try to stack the deck in your favor as best as possible. But accepting that you're going to lose is just part of becoming a seasoned investor, in my opinion.
Yeah, definitely. And I was shocked that he actually cut it loose. I thought he was maybe going to double down and take it. But I guess when it's $1 billion investment, it's probably better to cut loose, as you said.
And to his credit, I think his fund is only down 2% this year, even with that. I think it was a $400 million loss. So the guy is he's clearly getting a lot right if he's only down 2% when the whole market's been pretty much down. And he had that huge loser in Netflix. So, it's just part of the game, and learning risk management, which that's like you said, it's a huge emphasis in the book. It's something that a lot of retail investors, they just think if a company is going to be quote unquote the future, that they are going to, the stock is going to go up, and that's just not how it works.
Yeah, I think he sort of used the money that he made off a hedge potentially. I think that's what happened. He had an inflation hedge, made a heap of money off it using options, and then from there put it straight into Netflix. But obviously that didn't work out too well.
As long as he's not going on CNBC and crying and trying to push the market down like he does in March 2020, I will, I'm happy for the guy. I think that was a pretty scummy trade on his part. That's what we were talking about on the show, and kind of why we roast him on that, because it's you can never trust what Bill's saying.
Yeah.
But I have to give the guy a shout out. Not that he cares what I think, but it's I got to give the guy props for cutting the Netflix trade, and because it's just part of investing, is being able to take a loss and knowing when to get out and cut your losses before a loss turns into a bad loss. Because again, if it falls, I don't know the math on the top of my head, but if a stock falls like 80, 90%, I think if it falls 90%, it has to rise like, what is it? Like
1,000% or something.
1,000% or something. It's like insanity. So it's like, if you're riding, everyone's like, oh, I believe in Kathy Wood. It's like, well, it's like, how I know she says ARK is going to compound at 50% per year the next 5 years. Just like, all right, Kathy. Like, I've met Kathy before years ago. She was a speaker at a conference that my company was hosting. Super great lady. She was I was like very, very young at the time. But she was great. So I don't want to give her too much guff. But yeah, it's just like, who's your compliance officer right now, Kathy? If you're just out there saying you're gonna have 50% compound annual growth, I don't get it. But
we could open a whole new can of worms when talking about Kathy Wood, I think, especially what she's been saying recently. But maybe going a bit off topic, you mentioned there like financials and how they maybe have bounced back as you'd expect. I'm not sure. Do you think that we've seen an environment where a lot of people don't really believe the Fed and they don't think that they're going to raise as many interest rates? Because, we haven't really seen a risk off environment as you'd expect, or I don't know if you have an opinion on that.
So I think we're at a kind of a very confusing period with how the Fed is acting. I've been a Fed watcher basically my entire career. My background is more in economics and kind of that, for lack of a better word, like an academic approach to investing, which is not the best way to do it. The more that I've learned, I mean, look at John Maynard Keynes's investing performance. Is that all you need to see for that? But yeah, I think, the futures, I want to say, the bonds have just gone crazy in the last few weeks. But futures had been pricing, I want to say 7 hikes in 2022 alone until recently. It might have even gone up. I haven't checked it since, was it yesterday Powell announced the half-point hike, or at least confirmed the half-point hike at the next meeting, and said they kind of need to be aggressive. I think one thing that I keep coming back to with the Fed and inflation is that from the data I've been seeing, and from really people way smarter than me who know way more about supply chains than I do, it seems that inflation is more supply chain driven than monetary driven. So I don't really know how much these rate hikes are going to help. I do think that they need to hike rates in order to just have some semblance of credibility anymore, and to give them some room to ease if and when we fall into a recession, which I think is probably pretty likely. My working thesis is that we were going to have a mild recession here probably in the next year, but then Jim Cramer just said we're going to have a mild recession. And, if you follow the inverse Cramer on Twitter, it's probably likely that we're going to have like another global recession or something if he thinks it's going to be mild. But I think it's more supply chain driven, which is a function of COVID lockdowns and a labor shortage in a lot of countries. So I don't know if Fed raising rates is really going to do anything with inflation. I was happy to see that we were seeing some softening in the inflation numbers with the latest CPI report. And really, I think that's what the market is going to be looking at. I know the market seems to be really rates driven right now, especially with Powell's comments yesterday. But I also try and keep, I'm a long-term investor. I have a multi-year time horizon. The environment that I'm really looking for is they have to get inflation under control. That is priority number one for sure. But if it's supply chain driven, they have to get the COVID lockdowns just have to end at some point, at least in China. I know there's all these conspiracy theories as to why China is using these lockdowns, which I try and just keep it all data driven. But assuming that falls by the wayside here pretty soon, we should see supply chains get back on track. I know some estimates are saying by early 2023. But at that point, inflation should be softening a little bit more. And economic growth, whether we fall into a recession or growth just slows, that would be an environment. If the Fed has raised, I think the market's expecting rates to be at, 2.5% by the end of the year. That would give the Fed some room to potentially ease, because the best environment for equities that I've seen, that's come across my research, this is a big Stanley Druckenmiller thing, is that when the best environment for equities is a slow economy that the Fed is trying to get going by lowering rates or doing some sort of stimulus. And I think if we fall into that by early to mid 2023, the market's going to discount that probably even sooner, which could be bullish for equities. But that said, I think that the next few months are going to be a pretty challenging period for stocks. I hold I'm probably in, like 13%, 14% cash right now. I've got some puts, but again, I'm a long-term investor. My positions, I have some high growth, but like very small percentage of my portfolio. I'm just trying to compound my portfolio over many, many years. This is all short-term noise. Peter Lynch would call it a wall of worry that we're climbing right now. And all the investing books I've ever read, it's never been, oh, you have to sell your entire portfolio because the Fed's going to raise rates. It's like, that's not what I've ever heard a smart investor say. But I am looking for that Goldilocks period that Druckenmiller's talked about many times, which would be very good for risk assets, in my opinion. And to put a cap on that, just because the economy is weak doesn't mean that the stock market necessarily has to be weak either. So even if we do fall into a recession, I went and pulled all the data going back to the S&P 500 performance during recessions. The average return was actually about 3%, and that's including the 36 to 40% decline in 2008. And really, that was such a unique event because financials were, and for people out there who don't know, the S&P 500 is a market-weighted index, and financials were the largest component, kind of how tech is today. And a lot of banks fell by 80, 90%. So that's why the index got smoked so bad in 2008. I think people have some PTSD from 2008, and rightfully so. But just because we fall into recession doesn't mean that stocks have to, totally tank. I think it's something that a lot of people, especially new retail investors, are overlooking.
Yeah, there were so many great points there. And I think, as you said there, the Fed, it's looking like they're just going to raise until something breaks. And I think that's maybe not raise or even like just offload the balance sheet as well. So I guess that's maybe the concern that people have. But as you said, if once it breaks and maybe once it goes the opposite way, that's almost the perfect opportunity for people to get in. And we saw that in COVID, once they started providing liquidity, it's literally the perfect moment. It's gone up over 100% since then.
Exactly. And they're good. They're going to have to raise eventually. There's going to be a breaking point with bonds at some point. And I know Raoul Pal calls it the chart of truth. It's the long-term government bond yields chart. I wish we could pull it up here. It's basically a downward sloping, upward, what would it be? A trend line resistance above going down this trend line. And we're right at the top of that right now. I'm not the type of person that thinks this time is different. I do think that the Fed will keep raising rates, but it's like, how much of that has already been discounted by the market? I think kind of a lot. And if it turns out that it's mostly supply chain driven and not monetary driven, and the supply chains start to get back on track, which I know is going to take a while, then there's going to be a lot of opportunities here soon. And really, a lot of these, stocks are, even the index, the QQQs, NASDAQ was, I don't know if they're back in a bear market now, but pretty close from the all-time highs. A lot of the companies in the index are generating insane earnings. I know people, it's like, oh, we could be at peak earnings for companies like Google and Apple. And I'm just not really seeing that. And also it's like, maybe they'll be right eventually with that thesis, but they've also been saying that, every quarter for over a year. So it'll be a very interesting earnings cycle this quarter. I know Tesla reported the other day, great earnings. And I was interested to see that because of all the supply chain issues in Shenzhen, which I guess Musk said won't show up until next quarter. So I'm wondering if that'll be the same thing for, I think Apple and Microsoft report next week or the week after that. So it'll be interesting to see how these huge companies are managing these complex supply chains. But again, no, you're never going to know when the bottom is in, when it's actually in. And a lot of these companies have just been crushed. Nvidia is one. I think it's down like 20% in the last month. That's one I've kind of been nibbling on here. Because especially for retail, you're never going to be able to time the bottom or top perfectly. It's all about investing in companies that have, wide economic moats, what Buffett would talk about, but also trying to get it at a fair price. And I think, unless you think rates are going to the moon and the U.S. is going to have to, default on its debt, I have a running rule that the doom and gloom crowd is basically always wrong. At least has been for my entire career. They had a little party in 2008 and 2009, but overall, being bearish is usually a pretty bad. Long-term bear is usually a losing strategy. So what I try and do, especially in my age group, I'm 34 now. I have 30 years of investing time horizon left, I'm not too worried about an interest rate induced pullback. I don't think this is going to be like a lost decade. I don't think it's any of that is really in the cards, mainly because of demographics in the US. But yeah, so short term bearish. I think this quarter is going to be tough, but long term, I think we're in really good shape.
Yeah, and I think you mentioned the Nasdaq there. I'm pretty sure I saw that only 20% of the Nasdaq are above like the 200 EMA, and the rest are below it and have massive losses. So you mentioned some great companies there like Amazon, Google, Tesla. It seems like those are the companies that are almost keeping it up. Whereas we've seen some other great companies like some people, obviously Netflix is like down 60-70%, Spotify is down a lot, Shopify, all these other companies that are down a heap, but you'd still say they're pretty good companies.
Yeah, and I took some licks on Facebook. That was one of my, I think it was like my fifth largest position going into that last earnings report. So I wiped out all my gains from the previous year. So I'm trying not to let price dictate my conviction. But the peaking MAUs was rough. But yeah, I think, and that's another thing too, is all these companies have kind of been propping up the S&P 500 in particular and the Nasdaq. So it's like, are the generals going to get shot in the end, as some people are saying? Possible. But it's all the other side of that argument is, has the worst already been discounted? Because we've had, the rate expectations. I wish I would have looked it up before I came on, but they were expecting 725-point base hikes or basis point hikes through the rest of 2022 to bring the federal funds rate to, I think it was 2.25 or 2.5, which is, pretty high. That's a good amount of rate hikes there. So has the worst already been discounted? I mean, we had rate hikes, we had the war in Ukraine throwing commodities markets into disarray. We had the inflation going crazy. There's been a lot that's been thrown at the market, and the S&P 500 in particular has been pretty resilient during this entire time. So are there going to be those few companies that make it so we don't have a 2008 style pullback like we did with financials that kind of fueled that pullback? Or has the worst already been discounted? I don't really know the answer to that. All I'm trying to do is add to my core long positions. Usually when people are running around with their hair on fire, it was like when the day that Putin invaded Ukraine, where VIX went to 40 and people were just losing their minds. I was like, okay, like the old expression is, you want to be buying when the cannons are firing. So it's like, okay, what I'm going to do is I'm going to buy a leap on the S&P 500 right here. And I'm going to add to, my core positions. I added to Microsoft, I added to NVIDIA, which NVIDIA is actually down from there. But I think even my SPY leaps are up, pretty good from that point, even after the pullback we've had the last few days. And I added to my Bitcoin position there then as well. But because it's just, I want to kind of move against the grain when I can, or at least when I can realize it in the moment. I'm like, okay, so everybody's panicking right now. Historically, there's statistically really, when the VIX is above 40, it's one of the best times to buy. So I try and, Jedi mind trick myself into doing that and to try and be as unemotional as possible, which has worked out, at least in the short term. But if you look at the returns of when you buy SPY, when VIX is above 40 over 1, 3, and 5 year time horizons, I want to say even on 1 year, it's been higher 100% of the time. It was like 100 or like 98% of the time. And for me, I'll take those odds.
Yeah, definitely. And it's like what we mentioned before, it's like statistically, you want to be just winning at least 55-60% of the time. So if it's happened every time before, why wouldn't you do it? You almost have to do it, depending on obviously your strategy. But yeah.
It's hard to do though. That's I wrote, because part of what I do on my Patreon service, I have about 700 paid subscribers on there. Everybody subscribes for the stock picks. Everybody wants to see what's in my portfolio. That's like the main product. But what I really write about a lot, and I learned about this for years from Jared Dillian, because he's the master at sentiment analysis. And I talk about it. It's like, okay, this was a few weeks ago when Nasdaq tech stocks were rallying. And I was like, okay, so it's easy to buy when stocks are rallying. What's really hard, and it really is like a cheat code in the market, is when VIX is spiking. That's really when you want to be buying. And I was like, I think we're going to have like an opportunity here over the next 3 months where we're going to get another VIX spike. I don't know what it is. Could be a big earnings miss. It could be, an escalation in Ukraine. It could be another oil price spike. You never know what it's going to be. But it's like, I want you all to mentally prepare yourself to go and click that buy button on the high conviction idea. And I want you to get your shopping list together now. So in that moment that you're prepared, because it's all about being prepared and all about trying to, keep your emotions in check, which is, it's easy to say it and it's easy to read it when, things are going good. But when, the crap's hitting the fan, you have to be able to just, grin your teeth and press that button. And it might not be the exact bottom either, which I think a lot of new investors are like, oh, like you missed something, like we're down like 2% from yesterday. I'm like, okay. It's like, well, like that's not my time. Like 24 hours is not my time horizon for this. My time horizon is 2 years for this. So I think a lot of retail investors, and I think that's a product of like where a lot of people learn about finance originally. Whether it's in like movies and Hollywood, they think, investors make money by putting on these sexy trades and doing all this stuff. And I talk about it in the book. It's like, no, that's actually not how like that. For one, I mean, there are people that can do that, but for the vast majority, especially for retail, especially for new retail, it's like, you don't want to be trying to do that. You're competing with the best of the best in the world. You're competing with the, not even people anymore. It's, these quantitative models that are being created by PhDs from MIT and, all over the world, the smartest people in the world. It's like, do you really think you can compete with that? And again, there are people who can, and if you want to try to, the book basically shows you how to, use those strategies. If you want to trade options, if you want to, trade cryptocurrencies, it shows you how to do it where even if you do lose, you know how to manage the risk and you're not going to blow up your account, which, I have a 400,000 followers across all my channels. I've had a lot of people send me screenshots of their accounts where they're down like 90%, 95% on a $20,000 options trade. And they're like, well, like I thought that, why isn't this going up? Like Pfizer stock is still going up, but my thing's going down. I was like, well, do you know what implied volatility is? Do you know what implied volatility crushes? Do you know what theta decay is? Like the way I explain it is like options, they go rotten eventually. Like that's what theta decay is. Eventually, the contract wants to go to zero. So if you don't, know how to manage even that risk, which is super basic, but they haven't even heard of it, and they've committed, they've lost 20 grand or something. I've hundreds of messages like this over the last few years. So that was one reason it was a labor of love writing the book, but that was one thing I kept in mind the whole time. I was like, I feel like a lot of people actually really need this. And if I can, help some people, and, there's horror stories of people like losing their livelihoods, not knowing what they're doing in the market. So what I try and do is, and again, I'm not going to be right all the time, but I think that it will help, this new crop of investors kind of take all that enthusiasm they have for the market and just give it some structure. And that was kind of the goal of the book.
Yes, it's so vital, I think, as you said. And you mentioned there that, we might see the VIX up at 40 in the future. We do have Facebook or Meta earnings coming up in the next few days. So
yeah, I'm if I'm being perfectly honest, I'm a little nervous about that one. I was kind of pounding the table because, I mean, they do have a very great business. I think they have a great management team. They're kind of a boogeyman in terms of their, all the data they collect on people. They have headwinds from Apple, Apple's iOS changes. But I've used their digital ad platform. Most of their customers are small businesses on there. And we could see a pullback. Inflation could be hurting their ad spend in general, although it's not showing up with Google. Google's doing fine. It's showing up mainly on Facebook and with Facebook ads. But I think long-term Facebook's going to be fine. They're building out the metaverse right now. Their CapEx is going crazy. I know that people are like, oh, the stock is so cheap. Well, that EPS is going to go down because of all this metaverse spend they're doing right now. So it's not a valuation play for me. But for a while there, I thought they were going to be the next $1 trillion company. I still think that they can get there. I think Mark Zuckerberg is actually really underrated in terms of his savvy as a CEO and just a business mind in general. But yeah, a little bit nervous about especially after seeing the Netflix tank. Netflix shares tanked the other day. I was like, oh man, well, next week's going to be fun. But hey, that's part of the market. And it's all about managing the risk too. Like for me, it's like, Facebook's a big position for me, but it's like 6% of my portfolio. So it's like, I think the goal is to hold about like 20, and for my equity portfolio, hold around 20 stocks at most. So it's a big position in there, but even if, the stock, God forbid, gets cut in half, I don't think that that's going to happen. But even if it does, I'm going to be fine. My portfolio isn't going to be, I'm not like going to be setting myself back years. So that's that. Now all I'm thinking about is Facebook's earnings for next week. So I appreciate that, Anthony.
Sorry, yeah, I don't know. For some reason, I like Facebook as well, but I just feel this deja vu, like Netflix crash, and then like we saw Facebook before. So I'm hoping, I don't have any stocks, but yeah, I'm hoping for your sake it doesn't happen again.
Fingers crossed over here.
Yeah, definitely. So, yeah, as you mentioned, a lot of people, especially new retail investors, when they entered the market, it was through SPACs, NFTs, cryptocurrencies, a lot of the things that are in the title of your book. And so, I guess, why do you think they were attracted to that? And then why do you think they went so poorly when they try to enter the market?
I think they see other people making money in those sectors. Whether it's in the like meme coins or in NFTs and because it's like I lived in New Orleans for a long time. It's when I went to college. There's an artist there, Dr. John, and he's got a song that goes, "Everybody wants to get rich right away." And it's kind of what it pops in my head every now and then. It's like, nobody wants to wait. Nobody wants to wait to build wealth. Everyone wants to get rich right now. And that's a trap that, I think I forget where I saw it on Instagram, but it was like how some people think about investing. It's like, I want to make 8% today. And it's like, how you should really think about it is like, I want to make 8%, this year, like in the next 6 months or something. Because like the 8% in a day crowd, they're going to go broke. They're going to lose all that money. But almost guaranteed, I would say, if that's your approach, is to try and, I think this is just an example of like how terrible the investing content can be on TikTok. It was like this guy was like, if I make 10% a day for the next month, it's like, I'm going to be a millionaire. 10% on $5,000 or whatever. And I was like, oh, you're going to make 10% every day in the market. That's cool. That's cute. Show me the strategy, how this actually works. So I think that they're just attracted to, the money is at its most basic point. They don't want to work. I can relate. But again, that's why I try, and the book is all about, you can try and do that. You can try and use these strategies and invest in these risky assets, but you got to not do it like an idiot. You have to like know how to manage the risk and have a nice backbone in your portfolio too, that even if it doesn't go your way, you're not just like putting everything, like I like to play roulette when I'm in Vegas, but it's like, I know how to like manage the risk. And I only use a little bit of money on it because I know that the house always wins, So it's like, I understand people want to speculate. Speculating is fine, but you can't speculate with your entire portfolio unless you really like to lose money, because that's exactly what's going to happen. You're going to lose a lot of money if that's how you approach investing.
Yeah, and then I guess the issue is you see those outliers, and they're normally the people getting in early who make they do make the millions, but it might be one in a million who does that. And I think that's the issue. Everyone thinks they're special. That there's a classic you're your own hero in your own story, but it doesn't always work like that.
And there's also all these people on Instagram specifically, like, I have an Instagram account that has like 40,000 followers or whatever. It's mainly me on there, like, shit posting and stuff, but and posting like my videos and stuff on there. But there's people on there who are like lifestyle investing people, where it's like they're like flashing like big stacks of cash and like sitting on like a Ferrari. I'm like, okay, so that Ferrari's rented for sure. It's like, I was like, I've been around really rich people. It's like, that's not how really rich people act. At least in my experience, they're not flashing cash or, on these like fancy cars. It's like, that's what people who want you to think they have money or look like, and they're trying to sell you a course or something, so I think there's that plays into it a lot. It's just like everything on social media. It's like everything's kind of like the most rosy, this fantasy world that you're trying to portray to your followers, and whether that's in people's personal accounts or on accounts of like hundreds of thousands of followers. So I think people will see that and they just kind of think that's what happens when you invest, or if you get in on the right trades, that's what can happen. And really, that's just kind of a fantasy.
Yeah, and I think that's why it's important. Like people like yourself, and you mentioned Real Vision as well. There's actually like the legitimate people who have the experience in investments, and they can actually, you can still make profits, but you have to be realistic about it at the end of the day. I think that's important.
Exactly. And I think that's the one thing I try and do on because like TikTok, it's like all charlatans on there, and kind of I was one of the first people on there. So like when I started, it was me, and there's a few other guys who are good, I would say, but like 95% of the people on there that have probably only been investing for a few years. They were just like sending out like penny stock trades, and then like maybe someone like you can pump a stock pretty easily if you have a big following on there. So that people would build an audience like that. But it's like when the tide goes out, like it has the last year, you can see who really knows what they're doing. And like, I'm not saying I'm like I think my portfolio is down like 10% this year, 12% this year, which like isn't fun. It's like the way I structure my portfolio is that it's going to fall a little bit more than the market when the market falls. It's going to rise a little bit more when the market rises. So it's like I know it's structured that way, and I can handle the volatility. That's another thing, is that people think that they can handle the volatility that goes along with investing in these speculative assets. And it's easy to do it when it's going up all the time, when we're having this insane liquidity event that we had in 2020. But when it cuts the other way, people get mad, and they're like, they kind of think that like it was just some like free money machine. But one thing I'll often say on my content is that Wall Street is designed to take your money, not give it to you. So you have to always keep that in mind. If it seems like it's too easy to be making money in something, you're probably going to get the rug pulled out on you pretty soon.
Yeah, definitely. And if we look at the book, I found it really interesting because it's like separated into different assets. So I think to start with, it's more traditional assets like stocks and real estate and a few of those things as well. From there, you get like derivatives and what you can do with derivatives, and I guess finally is like the alternative investments. Was there like when you were doing the research for the book and I guess writing the book, was there something that you found interesting or that sort of really jumped out at you for one of these assets or for anything like that?
I think one thing was my business partner Jen, we have our show on the bullpen. She was a small cap analyst or small cap fund manager for years. So I don't really invest in small caps. Like if it's under $1 billion market cap, I usually don't even mess around with it because I always lose money. But that was kind of her specialty for years. So when I interviewed her for the case study for a chapter on it was about, what was it? Oh yeah, so it was during the financial crisis. She was running her fund, and she invested in a small cap that was actually a water utility. And I was like, huh. It's like I've written about one of the products I ran at Malden Economics was an income service. So it was like dividend paying stocks, business development companies, REITs, all that stuff. And I'd written about water utilities a lot because it's, for one, it's like a concept that like all retail can understand because everybody drinks water, needs water. It's a very fundamental basis of humanity. But she had this small cap that got completely decimated. It was in Arizona, and they had all these hookups to a housing development that basically was going bust. So I think at the time it was like, $100 million market cap. But she went in there and was like, hey, like eventually, this housing development is probably going to get filled up here in the next 5 years. Arizona has, net migration. There's favorable demographics here, and everybody needs water. So she went in there. I forget the name of the company. It's in the book, but it ended up being a fantastic trade that the fund that she ran that someone else has since taken over. It's still in there today, but it's compounded like crazy over there. It's probably like an 800 million market cap at this point. It's like, 100 million to 800 million. I'll take those odds any day. But I think that was one that I realized. I was like, oh, so there are, in even the small cap space, it's like there are pretty good, risk reward there if you know where to look. I'm more of a mid cap to large cap guy. I'll do cryptocurrencies as well to kind of generate that higher beta in my portfolio, and I'll even trade some options. I ran a options trading service at Malden for years as well, so I'm pretty experienced, using options effectively. And so I'll do that to kind of add some more alpha to my portfolio, hopefully alpha to my portfolio, but to add more risk if I see the opportunities there. But that was one, yeah, the small cap, micro cap stuff. was really interesting.
Yeah, and that's the thing. There's so many like investment vehicles that you don't even think about. And I think one that you mentioned in the book that really stuck out to me was like the business development companies, BDCSs, which I think is sort of private equities and you can sort of invest in them. But one that I think mentioned in the book was sort of like you can invest in liabilities. So I guess for companies that maybe can't get normal debt, they can sort of get it through these companies. And if you look at variable rates where they actually change with inflation, it could be an opportunity maybe with interest rates going up where investors could take advantage of that.
Yeah, because BDCs are interesting, which I used to write about. Again, I used to run a a high dividend paying stock service, but BDCs are interesting in a rising rate environment because it's harder to secure conventional bank loans when rates are higher. I mean, that's basically what BDCs are. They're kind of will take on higher risk loans, but that's one reason that they yield such it's usually around 8%, which in this environment is fantastic. Because banks, they tend to hold companies to stricter standards since the cost of capital is higher, for these companies. So, BDCs are a great one. I think the hold in the rising rate environment. I don't personally hold any, but if you are going to go look into them, all of them you can go is kind of see what their holdings are. And I try and look for ones if you want it as more of an inflation hedge and a low beta position, you can see whether they hold mostly defensive sectors in their portfolio. It's like stuff that will be a lot economically sensitive. So yeah, I'm a big fan of BDCs. Something I should probably look into honestly now. My portfolio is much more geared towards tech and large caps right now, since they're just so beaten down. But BDCs are great.
Yeah, definitely. And I guess you mentioned about so many mistakes that investors make. Are there any that you think that people should really watch out for? Any other ones maybe?
Yeah, I mean, I think the biggest one is just taking on more risk than you're comfortable with. For retail investors, everybody wants to make the high returns, but they don't realize that that cuts both ways a lot of times. So you have to really figure out. And it's just like a age-old question. It's like, who are you? Like, what are you comfortable with? Are you comfortable with your portfolio moving around 10% a day? Like if you're all like altcoins or something, which I know some people who do that, and they're only investing like money they don't need, and if they lose it, they'll be fine. But I think a lot of people, they don't really know that. They just look at the high gains that the people are making, and they're like, oh, like I want that. I can do that too. And then when it cuts the other way, or the trade doesn't go their way, then they don't know what to do. So I think that's a big one for new investors. Also, just not investing money that you can't afford to lose or money that you're going to need. Because again, it's an investment. Like I don't agree with this, but my old coworker Jared, he was like, if you had to buy a stock and only hang on to it, or had to hang on to it for like a set period of time, like you couldn't sell it for 6 months or something, he's like, investors would be so much happier because you would be like you wouldn't have even the option to sell if you needed to, because you'll be forced to think long term. Like his this thing he was writing years ago. He's like, I think free trading is like an abomination on finance, which I thought was kind of an interesting take. He can be a little edgy at times, a little edgelordy at times, but I thought that was a good one. So yeah, I think those would probably be the big two, and the one that I come across the most with my audience.
Yeah, well, I heard something, and I'm sure you've heard it as well, whereas the markets are an expensive place to find out who you are.
Definitely. And yeah, and that's one thing too. It's like when I get these messages from people, they lost a bunch of money. I'm like, hey, don't beat yourself up too much. Don't do it again, but just think of it as an expensive lesson.
Yeah, a bit of a tuition for hopefully your future financial freedom. So,
Mm-hmm.
Robert, thanks so much for joining the podcast. And just on to my last question, what is really the main message or that you want to get, you want people to get from this interview, or maybe even your book?
Well, from the book, it's if you're gonna do something risky, you gotta know what you're doing. You gotta know what you're getting yourself into. Don't just buy something or because you saw someone talk about it on social media. You gotta do your due diligence. It's way easier to ride a drawdown in a position if you know why you hold it. So read about the companies that you're investing in. Don't just blindly follow someone, even me, because my risk tolerance is probably different than yours. My investing goals are different than yours. So really like do some soul searching when you're investing. Don't just ape into stuff I hate like the meme stock culture, like the Wall Street bet stuff that glorifies like loss porn and all this stuff. It's like, I think that's like, it's a bastardization of what investing should be. And I think people lose money doing stuff like that, and then they're turned off from investing for the rest of their lives. And I think investing is really important for retirement, and really having building wealth. And I think that's what people really want. They just don't know how to get there. So I would ignore the Wall Street bets crowd and try and follow some people who actually know what they're talking about.
Yeah, it's vital. And that's the issue. I guess you could say it's been gamified the markets over the past few years. And it's, it's not a game. It's quite important for most people's, livelihood in the future.
Exactly.
So Robert, thanks so much for your time. And I guess, as you mentioned there, the book, it's released on the 10th of May. Would the best place be Amazon? Anywhere else that people could find it?
Amazon, Barnes and Nobles, Target. It's going to be all over the place. You can order it from Simon & Schuster's website. But yeah, it comes out May 10th. A Beginner's Guide to High Risk, High Reward Investing by Robert Ross. If you don't want to buy the book, that's fine. If you want to just follow me on social media and get all the free stuff, it's Tick Stocks. That's TIK Stocks on Instagram, Twitter, and TikTok.
Yeah, perfect. Now, I would say that, I've been investing for 4 years, and sometimes you think and I mentioned this to you before, you think the beginner guys like, oh, you're not going to get anything out of it. It's all going to be the same stuff. But I felt like I did get quite a lot out of this, and I learned quite a few things, which is great. So I would definitely recommend people buy it, especially if they, maybe want to be on the riskier side to do it properly.
Yep. Happy to hear it, man.
Thanks, Robert. Appreciate it.
Right.
Thank you so much, and all the best.
Yep. Thanks, man.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.